What's up, everyone, and welcome to the Daily Macro Update for Tuesday, December 16th. My name is Johnny Zerdy. Welcome to today's show. We have a bunch of data to go over. We had some jobs data come out. We had some payrolls data come out, as well as some manufacturing and services data from the S&P Global. And then we're also experiencing a pretty large sell-off in oil, and really the only thing that is doing well today, and really it's been the strongest trend that's been emerging so far ever since the Fed meeting, which is heavy metals. So we're going to go ahead and take a look at some of those on the charts as well. But for those of you who are joining, I appreciate you guys coming on here today and joining me on the daily. As always, if you guys appreciate this content, make sure that you are sharing this, liking it, doing all the things that the algorithm likes to push out the content. That is greatly appreciated. All right, so getting into the headlines for today, we have the jobs numbers for both finally the payroll numbers for both November as well as October. For the month of November, they added 64,000 jobs. When we take a look at the non-farm payrolls, we can see that in October, it was negative $105,000 in outflows. And then we had a little bit of a rebound to plus 64,000 jobs in November. Now, when breaking this up, whenever you take a look at the payrolls report, you always want to make sure that you're dividing it up between what private data or private jobs are doing versus government jobs, because those are really the two big contributors there. And so when taking a look at private jobs, we can see that there was a little bit of a dip, but it didn't go negative in October, and then it had a slight rebound there in November. But if we take a look at the government payrolls, you see that the majority of the decline from October was from job losses in government. And so that was the main contributor to the negative number that we saw during the October payrolls there. Also, too, we got the unemployment rate. So the headline unemployment rate shot up to 4.6%. This is the highest since November or September of 2021. And then also, too, when we take a look at U6 unemployment, that went up to 8.7%. So the U6 employment is a little bit more accurate because it includes those who are no longer actively looking for jobs, but have filed for unemployment between now and the past 4 weeks. So the U6 is a more broader outlook for the real unemployment rate, and the one that my team and I like to use. But of course, the market likes to look at the U3 unemployment rate, which is the headline that you see on the news. And so in any case, though, both of them went up to the highest levels since 2021, which was a little bit which was expected there. But yeah, I mean, most people thought that it was just going to tick up to 4.5. So the unemployment rate was a little bit of a shock there. Nothing too crazy, though. And at first, when these numbers came out in the morning, the market was celebrating a little bit because anytime you have bad data that comes out, the market celebrates it as bad news, right? And so that was, in the beginning there. But then we got some more data here, and we can just run through it. So we got the S&P Global putting out their numbers for the manufacturing index as well as the services index. And so the manufacturing activity continued to weaken for the 5th month in a row. And as you can see there, it's continuously declining. We'll see what happens there in terms of if that's sustainable, but still a lot higher than we saw back over the past year or so. And then if we look back 3 years, you can see that this has pretty much been on a steady increase, right? So overall, the manufacturing PMI, according to S&P Global, has been expanding. This is a lot different from the PMI or the ISM numbers, which were showing continued contraction, but that's what we're seeing there. The services sector showed continued declines as well, which is the lowest level that we've seen since June of this year. And so the S&P Global numbers for services looks a lot less optimistic than the manufacturing, which is pretty interesting. It's a little bit of a divergence between the S&P data versus the ISM data. Now, what was interesting was the New York Fed Services Activity Index also came out, showing that it's still in deeply negative territory. And really, the last time that we had a sustained uptrend in services activity was, during the second half of 2021, as well as a little bit of 2022, but not too much there. And if you go back to the max, or let's see, if we go back 10 years, you can see that, even from 2017 to 2020, up until the pandemic, this was pretty much in positive territory. And this still remains in negative territory here. So, I mean, that is showing that, the services economy is still in a slowdown, despite, the Atlanta Fed putting out, 3.5% for the GDP number this year. The real data is actually showing continued weakness. So that's pretty interesting and a little bit of a divergence from the leading data, which is showing more of expansion. But that's what we got there. Average hourly earnings year over year continue to decline to the lowest level, I think. Let's see. Really since the pandemic. And so, yeah, average hourly earnings continues to decline. That's not really what you want to see, this has been going down steadily for the past few years. And so that's pretty much what we're looking at in terms of the macro data. We continue to see that a headline CPI might come down a little bit. We have CPI coming out on Thursday, I believe, this week at 8:30 a.m. Yep. Not really too much data tomorrow for Wednesday, but we have CPI on Thursday and then core PCE on Friday. So the second half of this week will be mostly focused on inflation data. And so, for the October, November data, that's pretty much what it's showing is around 3%. So if it comes in at 3%, that'll pretty much be in line with expectations, whereas it's finally showing a little bit of a decline in headline CPI in December, not by much, but core CPI is remaining well into the threes. So that'll continue to show a 3% handle. And then when taking a look at core PCE, that is continuing to accelerate. So that's going in the opposite direction of what the Fed wants. And so, they're going to continue to go on TV and pander to the American public saying, hey, we're going to continue to slow rates or ease rates because inflation is only due to tariffs, nothing else. And so, they're going to continue to cut into technically accelerating inflation. But when taking a look at some of the more leading data, we can see like from the rate of change of oil, like we saw today, oil right now is at the lowest level, I believe, since 2021. If we take a look at a price chart of oil here and zoom out, yeah, oil has pretty much been in crash mode, which is a pretty decent indicator of global demand. But yeah, when taking a look at this right now, it's about to close in the next 3 minutes here. And the last time that the price of oil was at this level was back in February of 2021. And so as you can see, the pandemic, this was the drop there, and then it came back up. Had a huge surge throughout 2021 as well as in the beginning of 2022. And then ever since June of 2022, when inflation peaked, that's pretty much, it's shown that oil has been going downward and it continues to be in crash mode. And so a lot of oil derived type of assets have been, taking a little bit of a hit today. And then on the contrary, though, what we do have, well, actually, let me back up. So this decline in oil prices will continue to be a forward headwind for inflation, meaning that disinflation should be expected. Energy is one of the largest components of headline CPI. And so with oil continuing to go down, that's what will be the main contributor towards why headline inflation will come down. But it also explains how core CPI, which excludes energy and food, that remains at 3%. So the Fed still has a big problem here with inflation. They can deny it all they want, but it's something where it's just going to continue to be a problem because you're still having some supply constraints. You're having other disruptions as well. So yeah, I don't think that this inflation problem is going to go away as fast as the Fed thinks, but it doesn't really matter because they're going to do what they think, which means cutting interest rates into sticky inflation as well as rising demand there. So we'll see what happens. But in any case here, based on this, taking a look at the target rate probabilities for today, for the January 28th Fed meeting, the first Fed meeting of the year, that continues to show a 75% chance that they're going to pause. So no change on that front either. Taking a look at the yield curve here, we can see that the United States yield curve continues to steepen, and it's headed more towards a bull steepening, which is when the short end of the curve is falling faster than the long end, suggesting that we could be getting even more rate cuts from here. And so, yeah, with this steepening going on, this is mainly due to the Fed having to tailor to what the government is doing with their policy. And another word for that is called fiscal dominance, which Jim Bianco over at Bianco Research really put this into perspective. And is that when you take a look at other civilizations that have, fell into the trap of fiscal dominance, they don't last very long. And it's almost like, if you're in a room with some people and you pull the pin out of a hand grenade and you just hold it and you say, okay, who's going to be the first to get out of the room or whatever, right? At that point, the pin is already pulled in the grenade. It's not a matter of if it blows up, it's just a matter of when. And so, if this current administration gets what they want, where if they bring in a Fed chair as well as nominate a bunch of other, Fed representatives on the FOMC that are extremely dovish, and they tailor to this fiscal dominance, it is not going to end well. You're going to have rapid inflation from there. And yeah, that's going to accelerate the pretty bad long-term problems that we're about to run into here. There was another analogy that I saw on X where it's like everybody is in a car going 100 miles an hour towards a brick wall, and the people in the car are arguing, which seat they want. None of them are addressing the actual problem, which is to try and slow down the car. So I thought that analogy was pretty interesting and funny as well. But taking a look at, all of this in terms of strategic positioning, when taking a look at the dollar, as we know, the dollar is in a bearish trend right now, right? So the dollar is in a bearish trend because, you're seeing the Fed not only continue to lower rates, which is typically, bearish for the dollar, but you're also having, other central banks around the world being a little bit more hawkish and being cognizant of, some of their issues too. And so, yeah, this is getting the dollar to be or continue to be in bearish trend. We went bearish on it back at the beginning of the month. And so what you want to do is you want to pay attention to the different correlations of the dollar, right? And so what you want to do here is when we take a look at this metric here, which is something that my team and I have built, this is the rolling correlations versus whatever you want to, look at. And so in this case, this is the 15-day rolling correlation between these different assets listed here in this table versus the dollar. And so being on a 15-day rolling basis, this is a very short-term looking correlation. But what was interesting is that a lot of things have broken to the upside, being more correlated to the bearish dollar, which that's not good if you own those types of assets. What I'm referring to is things like owning bonds. Bonds, especially on the long end, are pretty bearish right now. In fact, there's a lot of people, trying to short bonds currently with the current fiscal policy that's in play. Also, too, you have oil, one of the most positively correlated trends with the dollar. Both are in deep bearish trend. And then some things that have gotten less oppositely correlated to the dollar. So things that that should be oppositely correlated that you would want to have is equities, Bitcoin, and commodities. So Bitcoin, the S&P 500, as well as commodities, have all had a huge jump from deeply negatively correlated to the dollar to now neutral or somewhat positively correlated, which that is a negative rate of change for those underlying assets, equities, commodities, and Bitcoin. Meanwhile, things that are continued to be a strong negative correlation to the dollar, which is positive for the underlying asset, are things like gold, which I don't know if you guys can see it here. Maybe I can increase the zoom a little bit. Yeah, that's a little bit better. But as you can see, gold as well as precious metals, the ETF DBP, those remain in deeply negative correlation territory on an immediate term 15-day basis. If we now expand that to a more constant 30-day rolling correlation, you can see a little bit of a different outlook here. And so you have bonds as well as oil continue to be in a positive correlation, as well as you have Bitcoin being slightly positive from deeply negative just from 1 month ago. So that's not great. It has lost a little bit of its positive correlation. So I guess that's positive on a quick 1 week rate of change basis. But yeah, so things that are continuously being negatively correlated are precious metals and gold, things like silver, and then also too, the S&P 500 on a 30-day rolling correlation is technically negative. So that is, good for equities as a whole, but just not in the short term. Now, taking a look at the chart here, when we take a look at the biggest mover today in terms of ETFs, that would be palladium. So as you can see here, platinum. This has had a pretty huge jump over the past couple weeks here. We were covering this and it went bullish in our model on November 28th. If you guys go back and watch the previous videos there. And then you had pretty much an entire week of accumulating this. You didn't really get it close to the low of the trading range, but you did have, excuse me, you did have a pretty decent, accumulation period there. Same thing with palladium. Palladium is having a breakout there. And those are the two big movers for today, along with cannabis. Something like MSOS, this continues higher as well, which is something of an outlier, but that's one of the trends that's continuing to rally here. But yeah, commodities, natural gas, gasoline, oil, all of these are losing tremendous amount of strength. A lot of them have broke trend today. So yeah, that was pretty interesting there. Taking a look at the S&P 500, it's had a little bit of a, down day. Early in the morning, it did have a little bit of a buying opportunity. So there was a little bit there, but, it still remains in bullish trend. And when looking at the ranges for tomorrow, top end of the trading range at 693, the low end of the trading range between 667 and 671. But yeah. Interesting seeing that, as well as, some of the biggest moving mega caps, one being Tesla. I think Tesla just closed at a new all-time high. Yes, it did. Tesla, new all-time highs, ladies and gentlemen. Don't want to chase this, though, since it just closed at the top end of the trading range there. So still want to be patient if you were to add it there. But yeah, interesting to see that. Let's see. That pretty much pulled up the entire Mag 7. Yeah, let's see. Apple had a little bit of an opportunity early on today. Walmart might be giving an opportunity later on this week. If you guys were bag holding Broadcom, gave you a little bit of a chance to get rid of it there. And then, yeah, we just saw a pretty decent move or bounce in consumer discretionary as well as tech today. Consumer discretionary is in a lot better trend than tech, though. So, but yeah, pretty much having a huge down day. The biggest being oil as well as energy. Take a look at XLE here. Now, this was on our actionable ideas of the week, but since this broke trend, this is no longer actionable. And so, yeah, pretty interesting break in energy. This ETF is typically pretty wild, so it's almost like you're trading a cryptocurrency. But that's pretty much all I have for you guys here in terms of the data. So we'll go ahead and get into some questions. Sean Matthew asks, why does the Fed still say they have no rate cuts priced in for January, even with a 4.6% unemployment? Well, the reason why is because they continue to flip-flop between, worrying about inflation or worrying about the labor market. And with some data, well, with a lot of data suggesting that the labor market disruption is more structural instead of demand-based, which there is a little bit of demand, right? The entire supply and demand curve for the labor market has shifted downward, right? So that equilibrium point is a lot lower due to the large migration out of people out of the workforce entirely. So, and that's a combination of factors. But with the Fed recognizing that more and more, if inflation continues to be higher for the next few months, then they really need to make a decision here. So, yeah, next gen '04, that's spot on there. We get inflation data actually on Thursday, not tomorrow. So, yeah, we don't get inflation data tomorrow. It's on Thursday. XOM took a huge dip today. Is this a buying opportunity here, or is it no longer bullish trend? Yeah, something like XOM, ExxonMobil. It was one of the bigger components within XLE, and yeah, this did break its bullish trend here. So, now if you own it, our process would say to just see what happens tomorrow. Yeah, I mean, I do own myself some Exxon. So, I mean, this dip here, it wasn't a dip to buy, right? This is a dip to wait and watch, essentially what happens in the next couple days. Good question, though. All right, let's go ahead and go over to TikTok here. We can answer some questions, and then we can go ahead and wrap it up. What about copper? Yeah, copper as well. Let's see here. Yeah, copper is in a much better, bullish trend. And so it's pretty interesting how you have both oil in a bearish trend and copper in a bullish trend. That's quite unusual. But yeah, so I mean, this is something that's more actionable. Yep, copper remains in bullish trend. Giorgio says, how much is the year pass? The year pass for what? Because we did offer um, a Black Friday deal where you could get a discount for the entire year. But um, if you're referring um, to the low ticket, that's just 15 bucks a month. But if you do want to join the 6 week macro investing challenge, then there are some spots left, which is available between now until the end of the year. So we shut it down on December 31st. So there are some slots available. And yeah, with that, it does require a deposit of $500 in order to participate, but it's just a temporary deposit. We give it back to you at the end. So it's essentially free. But yeah, if you want to learn more about that, just go to the link in my bio and book a time with me and we can discuss more about it. You mentioned that immigration is one of the issues with employment data, but certain people on Twitter are suggesting that those H-1Bs are taking jobs away from Americans. I'm not sure how accurate that is. Yeah, I mean, as far as, foreign workers, I think a lot of companies are taking advantage of, work abroad because it's less expensive. And so I'm not too familiar with the H-1B policy, but from what we've seen, immigration is still, there's been in terms of rate of change, has pretty much dropped off to zero. And so, yeah, that was a huge contributor towards the labor market remaining high, as we see. But yeah, it's a combination of the new immigration policy from this new administration, also with a lot of companies betting that AI is going to continue forward, and in some tech companies that has helped a lot with coding, but a lot of companies are withholding hiring because of the AI disruption, and then you also have a lot of boomers retiring. So it's just a combination of all those things that are contributing to this labor market right now. But all right, it is 4:15. We're going to go ahead and end it there. I appreciate everyone for joining, and we will see you in tomorrow's daily macro update. Bye, everyone.